Hello, everyone, and welcome to the AIM Summit webinar on ETFs, Moving Beyond Active. I'm your host, Zachary Sefarati, CEO and founder at Endowment Capital. We have over 30 countries participating in this session amongst your institutional investors, family offices, high net worth individuals, and leaders of the financial industry globally. Please feel free to submit your questions as they come throughout the session. You'll see a Zoom Q&A dialog at the bottom of your screen. If you're joining us on YouTube, please like this video and subscribe to our YouTube channel now. Go to www.aimsummit.com in order to subscribe to the live session so you can be part of the Q&A with our speakers. Introducing our webinar partner, Saxo Bank. They are the leading industry provider for multi-asset trading and investment platforms. We're glad to have them moderating and sponsoring this very interesting session, being led by none other than Nicholas Wright, who we've had many times on the AIM Summit platform. He's the head of institutional sales at Saxo Bank. So good to have you with us today, Nick.
Welcome to our third and final panel, where we have been discussing the changes in the wealth industry globally. In the first two sessions, we covered tech changes, regulation changes, demographic changes, social media and trends in social media, digital demands, big data, and obviously the new bank versus fintech scenario. Today, I'm glad to tell you we have three experts in their field, and we will be looking at actually how investors construct their portfolios and the changes that we've been seeing over the past 10 years and where we believe this will go in the future. So the three speakers are Eric Pollocktoff. He is Global Head of ETF Capital Markets at Invesco. We have Xiang Bull, who's Head of US Exchange Traded Products at NASDAQ. And we have Greg Freeman, who's Head of ETF Management and Strategy at Fidelity. So welcome, guys. Real pleasure to have you, and I look forward to some really interesting debate. So why don't we kick off exactly there? There has been an exponential growth in passive investments, pretty much since the last financial crisis, so over the past 10 years. Why do you think that's happened? Let's start off with that, and let's start off with Greg.
Well, I think, and first of all, good morning. Thank you for having me. I think, index or passive investing has always been an important part of someone's portfolio. We've had many debates and conferences in the past of, is it active versus passive? And the right answer has always been both. A really good diversified portfolio gives clients and needs clients to have both active and passive. And I think right after the financial crisis, the environment in the market was very favorable towards passive investing. The indexes performed well in comparison to active management. And I think it's a cyclical approach. I think we're entering a phase now where active investing has a chance to really outperform and shine. Right after the crisis, I think because of the volatility, index strategies really performed well in comparison to its active. And that's why I think for individuals and advisors and institutional, to be honest, portfolios, it's really good to have both active versus passive. So, while the headlines might have been passive took the day, it's cyclical. I think we're entering a period now where active has a great chance. So it's really, a story of both in my mind.
Absolutely. And Eric, what are some of the perceived benefits of going with a passive portfolio versus an active?
Yeah, I mean, from my perspective,
or vice versa, by the way.
Yeah, no, it's a good question. I mean, from my perspective, it's about your goals, and it's about the wrapper to help you achieve those goals. So, if your goal is to save for retirement, maybe this portfolio makes sense for you. If your goal is to, beat the market, then you may want to, think about this type of portfolio that moves more towards an active tilt. So again, I think it's much more of a question around what is your goal, what are you trying to achieve with the assets that you're looking to invest into, as opposed to like Greg said, active versus passive. And then if you go a step further, it's what type of wrapper do you want to have in your portfolio? And some technologies are better than others, depending again on what your goals are. So if you're looking at passive, the ETF wrapper maybe advantageous from a tax perspective. But if you're saving for retirement, you kind of lose those tax benefits, at least in the United States, and the way the tax code is written here. So you may want to be invested in an SMA that is using a tax harvesting strategy. So again, it really depends upon your goal. Once you figure out what your goal is, then it's really about what kind of wrapper that you want to put into your investment.
Got it. So clearly we have seen outflows from active funds, and we have seen inflows into passive. And I think this was tested last year. And I think this is probably an interesting point to really start examining where we are in the cycle, and the fact that we had huge volatility last year, obviously COVID inspired, followed by a very quick market recovery. Do you think, so what I noticed, and I've seen, and Zhang, this is pointed at you, clearly there were active outflows in the first quarter when we had that market correction of around 267 billion. Passive index trackers were kind of constant. They had a little inflow, and the big gainer was, the ETF, the passive ETFs, which had a staggering 60 billion in inflows, and that's Q1 last year, when obviously the whole industry was tested. I've just read an article. The guy's called Charles Ellis. He's just issued a new book, and he basically says there's never been a better time to be a passive investor, and he believes it's really hard to be an active fund manager today, given that information is available to everybody, and so it's not so easy to find possibly the stories that 15 years ago you would have worked hard to find as a fund manager. But my question to you is, now we're at this point, I'm noticing that the markets are taking starting to cool off a bit with the threat of inflation. We had volatility last year. However, last year tested the market, and it tested people's theories, and it still seems that there's flow coming into passive. Do you think that changes? Do you think we still see a lot more inflow? What's your feeling?
Yeah, you've seen the global passive investment at 15 trillion today, and that continued to grow tremendously. And ETF is a big proponent of that growth. Now at 8 trillion in assets in global ETFs, you really saw tremendous growth in 2020 because you really saw that market volatility because of COVID last year show the resiliency of ETFs. ETF became a source of transparency and liquidity, and it really grew the adoption for ETF even further. And as Greg and Eric mentioned, it's not about passive or active, it's about ETF as a wrapper for your investment solution. It's a choice that a lot of investors are demanding for, especially with the liquidity and the tax benefits of that. And there's been a lot of innovation in passive and active investing. From a passive standpoint, it's evolved beyond the core benchmarks. There's a growth in smart beta, there's a growth in thematic passive investing. So it really has evolved beyond just the broad market exposure. And then from the active side, it's been growing tremendously as well. Over the last 18 months, you really see active take off because investors are looking for ways to gain alpha, and active is a way to look for that. And Eric and Greg's companies have been really leaders in launching actively managed ETFs. The global active ETF AUM has grown more than 10% in Q1, so there's over 300 billion in assets in global active versus the 7% growth in overall ETFs. So you really do see that this is a next frontier in terms of new product development. And we expect that growth to continue to grow, and it's still very early stages when it comes to actively managed ETFs. And there's been a lot of regulatory changes, especially in the US, to make sure that there's more streamlined process to launch ETFs, especially for active management. As you talk about transparency, there's ways for issuers to be able to launch products and still be able to protect their IP behind it. And
you brought up a very good point. So the concept now of an active ETF, and I guess also smart beta, right? This the industry's answer. That's a kind of a blend of of both. And as you say, Eric, it's more about the wrapper rather than the product inside. And it also gives because I mean, one of the consequences of going so passive has been a fee compression, right? That can't be easy for the industry to tolerate. And I think, fees have gone from 37% margin to, they've taken a decent hit. I think we're down to about 27% now margin. So this active ETF and smart beta, is that the future? Certainly seems that the industry is favoring this.
Yeah, so again, I think it depends upon where you are in the world. For the United States, as Zhang alluded to, the active compound annual growth rate is higher than the average of the regular non-actively managed ETF or index-based product. That being said, in the United States specifically, there is a movement that will be happening over the coming few years where I think the real growth for the ETF wrapper will be around the conversion of actively managed mutual funds into the ETF wrapper. We've seen it happen for the first time ever this year, and there's a large company that's planning on doing more of that later this year. So again, though, if we go back to the initial conversation, is what are you trying to accomplish here, right? Active potentially has the goal of outperforming a set index, whether it be the aggregate bond index, the S&P 500, whatever the case may be, and that effort may cost you as the investor slightly more because that portfolio manager or team of portfolio managers needs research, needs due diligence, needs to do a little bit more diving into maybe a single security, for example, or a single bond, etc. That being said, not that the other thing that I think we're kind of conflating here sometimes, though, is that in the passive space or index-based products, again, whether it be a mutual fund wrapper, SMA, closed-end fund, ETF, etc., it's generally very actively managed within a portfolio, right? So I know that, listen, I trade in my personal account, I own only ETFs, but I don't just sit there and then I walk away from it, and 10 years later I come back and pray that it's up, right? I actively look at it, and based upon the signals that I look towards, I make active strategy decisions on managing that portfolio. And I think, in the advice world, particularly in the United States and in the UK specifically, the advisor world or FA world, those people are not just setting it and forgetting it just with ETFs. They are using maybe the passive to get exposure, but then they're actively managing it based upon inflation, interest rate, etc., on things that are ongoing in the macro level to help, again, to my point, help their investors achieve their goals.
Definitely. Greg, you're obviously Fidelity's on both sides of the table here. Again, anything? Do you agree with Eric on this kind of blending of the different wrappers and the products inside?
I mean, Jen, I always agree with Eric. That's just a rule of thumb I have. I think it's an interesting conversation because, to your point, Nick, that you made, ETFs have different investments inside them. And Eric made this point, and so is Jing, that ETFs is just a wrapper. Now, unfortunately, ETFs have been associated with index funds because that's all we had in the ETF wrapper since 1994. So yes, indexing has, had a big boom, and partly it's because the indexes are up 10, 15, 20%. It's hard to beat on active. And to your point, I think, active investing has a tremendous runway of potential when it comes to small cap and for the US investor, non-US equity. For a large cap US equity fund, it's a little more difficult. It's still there, and we have great firms throughout the world that can find value in large cap US equity, for example, but it's less than mid cap, a small cap, or a non-US equity. So indexing has had a boom, and it's been associated with ETFs just because of the nature of where ETF industry has been. Now, I think as we look forward, current and forward, in the ETF wrapper, you have smart beta, to your point, which is a way for a lot of active shops to dip their toe in the water to create really sophisticated tools, scalpel-like tools for, they have been historically for institutions, now available to advisors and retail with momentum, volatility. How do I solve a problem? So if you think about, 3 different chapters of the ETF story, the first chapter being index, which is dominated. The second chapter is smart beta, which is solutions, outcomes. I have a problem. How do I solve my investment problem? And the third piece, which we're in now, is active. We've had active fixed income for almost 10 years now, approximately. We've had active equity now for almost a year. So, it's the storyline gets confused because people think ETFs and index. Well, no, ETFs is just a wrapper. ETFs now have index, smart beta, and active, just like the mutual fund. And, I think, part of the boom in ETFs have been because it's been associated with indexing, no doubt. But I think also you have a different type of investor. So we're blessed at Fidelity to have a lot of rich data. And, we believe in choice, value, and innovation. How do we give our clients the choice and they choose the wrapper? Is it an SMA? Is it a model? Is it an index? Is it an ETF, et cetera? And the ETF client is very different than the mutual fund client. The mutual fund client is going to be really focused on, retirement type accounts, tax deferred type accounts. The ETF user seems to be a little bit younger, more millennial, more open to trading, and a little more sophisticated in some ways. So, we're all the firms here, Eric's firm and the exchange with Jing, is how do we bring the best of our capabilities to our clients, regardless of the wrapper. And we're blessed now as an industry to be offered mutual funds and ETFs, index, smart beta, and active, and helping the client, put together that portfolio that solves their needs.
I think that's an excellent segue, actually, because there are many structural changes that are happening in the wealth industry and the product industry. We've seen a move away from commission as a way to reward advisors. We've seen greater regulation on fee transparency. We've seen social changes which have led to robo-advisories. We've seen now in Europe and the Middle East, certainly, we're seeing a huge demand now and new startup fintechs competing with banks, with their robo-advisors to target the mass affluent and potentially the retail. Never before has it been so good for these players, these investors, who have really been limited in their ability to get to the market. So given all of these changes, structural changes, Xiang, again, I think, Greg really hit a mark there that maybe indexing was the fashion, and, you can keep your fees really low and follow an index, and obviously scale is important, but now you're evolving to enable, all these structural changes and a much more diversified portfolio at a better cost point. What's your thoughts on the structural changes pushing the industry?
Yeah, like you said, there's never been more choice for investors to enter the market. There's a lot of different ways, and it's never been cheaper for investors to trade. So you really see an influx of investors that are entering the market, especially during the times of volatility last year, and then the COVID lockdown. A lot of people grew an interest in investing, and especially in the US, you see a rise of the retail investor. The retail volume has gone up significantly in the US and globally. And something that a lot of these platforms, as well as exchanges and asset managers like Invesco and Fidelity do, is we're very focused on investor education. So best practices for trading, what the value of diversification, especially, how ETF can provide value for that. But as you talk about the future of wealth management, like one of the things that I think that ETFs has really benefited is the growth of model portfolios. So ETF model portfolios allow wealth managers and financial advisors to leverage the scale and investment expertise of Greg and Eric's team, as well as other issuers, and allow them to really focus on the business development, on client management, things that for them to really cater to their investors' needs and be able to leverage the asset managers for that scale. And there's been a lot of introduction of new technology, whether it's about tax management or ways to reduce costs to really benefit the end investor.
I completely agree, and we see that absolutely at Saxo Bank and across our markets. The demand for this type of service, moving away from the financial advisor to a more digital service, being able to literally structure your portfolio around your goals, using, as you said, world-beating fund managers to do that, such as your two. I want to go at a different angle slightly. Do we have any dangers in the market now with such huge numbers following, these products, the herd mentality? If we go back to indexing, index events can it not lead to quite a lot of price distortion from the underlying? Obviously, it's been a pastime or a way that active can actually gain alpha, is trading around these events. But, what are the risks? And I'll throw that one open to whoever wants to answer that. Don't all go at once, though.
No, Nick, I'll throw my hat in the ring. When I think about the risks, particularly for investors, it's always about understanding what you own, and whether, again, technology agnostic. So you can own a mutual fund, you can own an ETF, you can own a stock, you can own SPACs or special purpose acquisition companies now, that have different rules set up for them than, say, a regular quote unquote IBM IPO. So I think it's ultimately, as the central bank system globally has pumped so much liquidity into the marketplace, it's allowed everyone, or not everyone, but many people to take those dollars or yen or euro and put it to work in something. And that has elevated, to Zhang's earlier point, a whole new swath of investors that we label as retail, that may not fully grasp the things that they're buying and selling. And if we look at the cryptocurrency space, and the sheer growth from zero, 10 years ago to over 2 trillion, with multiple types of coins or cryptocurrencies that are being invested in, understanding how those things function and work is paramount. And unfortunately, from my perspective, and as much as Greg, who manages, Fidelity manages one of the largest retail platforms in the world, it's almost impossible to get to every investor to try to teach them the rights and the wrongs. And we've seen some people get hurt. And unfortunately, that's part of the risk of investing money. Now, again, if the global financial system slowly pulls some of that liquidity out of the system, which I think is starting to happen, we were talking about this earlier, should potentially cause a liquidity shock to certain asset classes. And then you might see a decline in the values of those assets, and therefore you will see a decline in balances at sort of everybody's level, including retail. So again, I think from a risk perspective, it's not active versus passive. It's not mutual fund versus ETF. It's not cryptocurrency versus bond trading. It's really just about understanding what you have, what you're wanting to invest in, and thinking about your goals and making sure that you stay tried and true to them. That's really kind of the biggest risk that I see in the marketplace now.
Let me add, or let me dig a bit deeper. So I used to basically run trading for a broker here in the Middle East. And as you may or may not know, a lot of the GCC markets were upgraded from Frontier to EM status, which was obviously a big index event. And the markets were overwhelmed by these events, so to speak, leading to humongous price distortions and volatility. So now, obviously, that's an unprecedented event. You don't see that happening too often, but obviously coming back, to a lot of money flowing into new stocks or flowing out of stocks if something has been taken out of an index. Again, can this destabilize Anyone?
So, we've had this discussion, and in fact, I think some of us have actually, talked to some of the U.S. congressional representatives about this notion. And the topic you're really digging into is kind of indexing, away from wrapper, away from
Right.
This is truly an indexing conversation. And there's pros and cons. Indexing has opened up the ability for individuals and advisors, non-institutional players, to get access to asset classes that probably were never really accessible before. People from the US couldn't buy, Saudi Arabia or Germany or UK or France, because you had to buy individual securities and you had to have a local custodian, and it was just a headache. Now with ETFs, mutual funds, and really indexing, you're allowed to get exposure to asset classes easily and cheaply that you weren't before. So that's a benefit, number one. Number two, I think it does bring economic flow into those particular indexes and those companies, where in the past they might not have been covered. They might not have had the exposure to such a broad swath of investors across the world. So that's a benefit. I think the negative, and it does exist, is there's probably some overinflation of corporates. Some companies, the financials might say you're worth $10, but because the index is soaring and you're in an index, it might, your valuation might be 15 overvalued from where kind of fundamental numbers are. So, that is a risk. And that's one of the downsides of indexing, but there's a lot of positives too. And I think, the index events are getting bigger, but you've got tremendous amount of global banks, market makers, traders, asset managers, exchanges that are looking at this, that are monitoring, local regulators, here in the US, it's the SEC, to make sure that there is not manipulation, that there is not dislocation for the market. So when a retail or advisor is entering the space, that they are getting taken advantage of. So yes, volatility is tremendous during those index changes. There's a lot of trading. There's a lot of people who are making money off those trades, but it's part of the nature of the industry, which is, yes, there might be some things that, Eric and I and Gene might not say are fantastic, but there's so many more benefits that outweigh, some of the negatives that are perceived.
I completely agree. And my final point on this to Zhang is, you're absolutely right. People are getting access to parts of the world, to markets, to instruments inside their portfolios via an ETF or a fund that they never would have had before at a reasonably good price. They're also, though, at the same time, fairly detached from the underlying. And I think maybe that's the concern, you have a more of a focus on the portfolio than underlying securities. And that's and there's no particular evidence of this. I'm just bringing these points up because I think they're quite topical and interesting. There's even the suggestion that it will lead to less discipline. So with active investors who, let's say, buy a firm, take a position in a firm, they can vote with their feet if they don't like a decision by the board, or if they think something's unethical. When you have, big percentages of companies owned by millions of individuals inside of funds, does that not pose a slight, does that pose any issue with market discipline?
I don't think so. Yes, I think you're right. It's detached. Everything's electronic online. I mean, you can buy anything online now, and you don't have the tax. When I was younger, which I am younger than Eric, just for the record.
Not even close.
You used to do research on the company. You felt like you knew the company. My parents and my grandparents used to get certificates that show that you own that company. So there is an attachment. There is a more due diligence. You weren't buying and selling as much as you potentially today. And I think an interesting notion is, people always say ETF, holders are traders. And they stay traders all day. They're in their basement and they trade, which is kind of what we've all been doing for a year and a half now, from a work perspective. But the data that we show is that most ETF users on the Fidelity platform hold their ETF for 6 to 8 months. So, a lot of people aren't day trading. So I think your notion is correct that yes, there's maybe a more detached feel, more transactional. Same way I buy things on Amazon now, where before I had to do research and go to the store. Same thing has happened on the investment side. So there is a little more detachment, but at the same time, once again, I'm always the glass half full guy. It's given a lot more price advantage. So it's cheaper to transact, it's cheaper to invest. I think you've got a lot more safeguards and a lot more abilities to get into products and be protected by products than ever before. I think, the cost of investing has gone down, and the transparency. As an industry, we are fantastic at creating jargon, at creating terminology that makes this thing the most complex thing you could possibly do is invest. So by democratizing it a little bit, I'm not
Yep.
sure about making it up. I heard from Eric. It's coming to the masses, which is good because it's transparency, costs, controls. But to your point, I agree. It's a little more removed. It's like, buying a case of soda on Amazon. I can buy, an S&P 500 fund, same time.
Yeah. And I think the diversification is a benefit to ETFs, especially for new investors who want to invest in a large segment or a theme. Like, you don't have to pick just one. Like, you can buy all the technology stocks in one single ETFs and have exposure to all of them. So that, diversification has always been a big benefit of ETFs or index fund or mutual funds. And it just allows you that broad access to the market. And I think that's also really beneficial to new investors who are entering the space. It reduces a lot of the risk that they're taking on, and instead of buying the single stock names. Like what Eric mentioned before, is know what you own. So hopefully these are things that the investors are looking at. You're still researching all the underlying companies that are being held within your ETF, so that the weightings is according to what you want to be weighted towards when it comes to the underlying stocks as well.
So bottom line is, it's never been simpler. You've never been able to get such diversification, and then you've never been able to do it so cheaply. That overweighs the fact that it's less sticky. Is that kind of, the panel agrees on that?
So yeah, I mean, Nick, I think about it in this way. 40 years ago, maybe 30 years ago, if in the United States, if you wanted to go to see a movie, what did you have to do? All right, first you have to know and hear about the movie. How did you figure that out? Probably television, right? Then you had to get a newspaper to find out if that movie was playing around you somewhere at a movie theater. Then you had to see and look up if there was a time available for the movie that you and your wife wanted to see. Then you had to travel there to go see it, right? All those steps had to be, you had to go there, you had to go buy a ticket at a box office, you had to take the ticket, you had to give it to somebody to rip in half so you can go sit in the theater and watch a movie. An entirely long experience. Now, you got one of these, right? And here, I can not only buy a movie ticket and still go to the theater, I can buy the movie here and just watch it on my phone, right? So it's just the ease of use has occurred for investors as well. Yep. And it's not just the US, it is global. And there are caveats that have to be, taken into account when you have this ease of use for investing. And I don't think it'd be quite open. I don't think that most investors are looking and doing the things that we're trying to teach them to do with regards to how they buy and sell things. But we have to do our best to make sure that we're educating as many people in the best way possible that makes the most sense, so that they make a good investment decision based upon, like I said, their goals.
Excellent. There's a question that's come in from the audience. I think it's the one that everybody's dying to hear your opinions on. So I'm going to ask it now. Given that we might be in late cycle, does the panel think that would favor active management over indexing?
My 2 cents, and what we are telling our clients at Fidelity is this is a great time for active investing. I think the late cycle does lead to it. It gives some abilities to find value in some of the stocks in the portfolio. So as I said in the very beginning, I think it's always good to have a blend, but I think we're in a good period for active investing right now.
Yeah, and my 2 cents is I just look at historical patterns and historical numbers. The S&P index versus active numbers they're real. They're here. You can see them. SPIVA is what we call it in the industry. And the active space has continuously had difficulties outperforming index-based strategies in various cycles. There are certain times where it may make more sense in certain asset classes, but at the end of the day, I think costs are part of the larger conversation and need to be taken into account with regards to active versus passive.
You're looking at the new launches in the US. Over the past 2 years, you've seen an increase in number of active ETF being launched, especially in the US. And a lot of the strategies we're seeing, especially from an active standpoint, is risk management actively derivative-based products. So, going into the late cycle, it's giving you exposure to the broad market, but also being able to protect some of the downside has been a growth in the product strategy that we've seen.
Definitely. Guys, I think it was Eric, I think you mentioned the SPAC phase. How does that affect the ETF industry? That's come from a member of the audience.
There are ETFs listed in the United States that own special purpose acquisition companies or SPACs in sort of an index fashion. I don't think SPACs directly affect the ETF industry. I think if anything, and Zhang could probably speak more to this, it affects the IPO process of a company and the due diligence that needs to be done for that company to go public. And I think that's the real effect, not so much on the ETF industry, so to speak, but more I think on the exchange and the IPO process of a company becoming investable.
Zhang?
Yes, SPACs has brought a new way for, like Eric said, for companies to go public. You don't have to go through the traditional IPO process and have the lengthy process. You can go through a direct listing or SPACs, and you've really seen a SPAC boom over the past really 18 months. And it's starting to cool down a little bit, but really the beginning of this year has been tremendous growth. A lot of companies, earlier startups in the cycle has been able to go public through the SPAC structure. And it just provides a new way for you to access that capital much earlier on.
Yeah. Just moving the conversation a little bit, Greg, I see the numbers on fixed income are lagging equities in terms of ETFs. I think ETFs account for about half of all equity mutual funds, and it's about a third in fixed income. Is there a reason why that would be?
Well, on the ETF side, you remember equity started in 1994 with the spider, and then a long run of fixed income ETFs didn't really hit the marketplace till early 2000s. So there was a huge amount of ETFs following every single index that you could possibly envision. So that's number one. Number two, the equity market is just naturally bigger than the fixed income market here in the U.S. So I think there's fewer players, large players are doing fixed income ETFs. So between the asset managers, just the nuances of the market as well as timing of when products come to market, I think that's probably a majority of the reason why there's a larger equity ETF business than fixed income. Now, with that being said, we've seen tremendous growth over the last 10 years of fixed income ETFs. There's not as many indexes, but you've got a lot of great products produced by a lot of great sponsors that give clients that access to that fixed income market. And you always have, and the benefit is, once again, I always take both sides and argue against myself. At least I keep the conversation going that way. Is that we are able to get active fixed income ETFs to market much faster than active equity, just because of the nature and the ability and the willingness of managers to be fully transparent with their active strategies in the fixed income space, while not so much on the active equity till recently. So I think it's just a byproduct of the market, byproduct of timing, and byproduct of products available that equity is larger than fixed income.
There's also growth in using fixed income ETFs as hedging tools, right?
Correct. I mean, across the board, equity and fixed income. You can hedge, an ETF, just as you could as a future or an option based.
Okay, guys, another hot topic right now: ESG. And, traditionally ESG has been more of an active play, but I notice now we're seeing a big increase in ESG trackers and passives. Zhang, what are you seeing out there? Do you think this is going to continue? I see huge increase in both retail and institutional demand for this, and obviously very much driven in Europe, but I'm sure you're seeing it in the US.
Yeah, definitely. Like you said, ESG demand has grown significantly, and it's really been accelerated because of the COVID pandemic. And we've seen a surge in terms of flow into ESG ETFs, especially as you said in Europe, but we saw that in the US as well. Globally last year there was $89 billion that flowed into ESG ETFs versus which is well above close to 30 billion the year before. So there's a lot more growth in ESG products that we're expecting. In the US, when it comes to new launches this year, we're seeing a tremendous new amount of products that are in the ESG space. And there's been, you're seeing that's because of investors' demand, but also global policymakers that are committed to providing sustainable changes that will really benefit the ESG investment. But one of the challenges that we really see in terms of ESG investing is around the data. So there's a lot, Europe has a lot more regulations in terms of data disclosure in terms of ESG, and there's a lot more we can do in the US to provide better standardization and transparency into ESG data to really further promote the growth of ESG investing. And one of the things that NASDAQ's been focused on is we have a proposal with the SEC for companies to disclose more of their board diversity information, as well as having additional board diversity, just people sitting on board and disclosure. So that's really one of our first steps into helping with this data disclosure.
Interesting. Guys, what are you seeing in your houses? Are you seeing, do you have product development in this area, and are you seeing demand?
So for us at Invesco, we've always had ESG strategies, mostly in the active space. The thematic ESG products that we run have been established and around for a long time too, such as water themed or solar energy in the ETF wrapper. I think there's a couple of kind of things that are still hampering growth within the United States. As you mentioned, Nick, the adoption in Europe has been pronounced and has been there for quite some time.
Political.
I think that's part of it. I think there's also, I think a clear definition of what environmental, social, and governance means is still needed globally. And I still think that that's part one of it. Part two of it is I believe that most American investors vote with their wallet in what they think is going to make them money, as opposed to vote with their heart, which is really what I believe to be personally ESG investing. Is you believe in a company, or you believe in a product that is doing well, either in one of those three, ESG columns, or all of them. And I think that is a different mentality than I think the average US American investor is used to doing.
Interesting. Okay, I noticed recently there was a ruling against S&P Dow Jones. Obviously, the providers and the creators of indexes such as S&P Dow Jones, MSCI, et cetera, have become leading firms in Wall Street, and very profitable entities and very powerful. Do you think that there's going to be more regulation coming about how you create an index and what regulation you need, and the authenticity of the data and the accuracy of the data?
Yeah, I'm not sure there's more regulation that's required. I mean, we've had indexes, for a long time now. And these firms are all great firms. They have integrity, they have boards, they have independence, they have reporting. I mean, they're great partners to us on the asset management side, as well as valuable tools for the investment community. In some ways, they've been on the front foot with, how to create these fantastic instruments to get exposures to various products, from ESG to volatility to factors to pure market cap, equally weighted. you name it, they were able to provide the industry with tools that really allowed it to explode, as we talked about earlier today around indexing. I think, there's enough regulations currently about when they release data, the fairness of data, the timing of such release, the independence of boards. And as a firsthand, my background being pure indexing now at Fidelity, I've seen the growth, but I've seen tremendous work done by the regulators, by the index providers, the partnership. So I don't see them getting out of whack or out of sync from what the industry is. In fact, they've always been very responsible and very strong partners for all of us in the investment community.
Sure. Zhang, working at the exchange, how do you see this?
Yeah, I agree with Greg. There are IOSCO and ESMA standards out there for index that they're following. There's index committee, there's index oversight, and so there's a lot of parameters that and procedures that are set up for the index business already. And so we continue to see there's a lot of internal compliance that's already done, and there are the industry-wide standards for them to follow. So I think it's great that the SEC is looking at these one-offs, and it continues to really shows the framework is working well the way it is. And so I can't I don't expect and don't want to speculate anything on that.
So what I've learned so far from this panel, which has been, I think we've covered quite extensively all aspects of passive versus active. But what generally my summary would be that it's never been so good for an investor, right? The choice, the cost, the diversification, and now we're moving into, the ESG, so you've got ethical options, you've got fixed income, you've got every kind of asset class that you can get wrapped in either a mutual fund or an ETF. Dare I bring it up? Crypto. I see that there is crypto ETFs coming, or many waiting to be licensed. How do we feel about that? Do we think that can be added to the mix and will be added to the mix?
You can't talk about it, Greg.
Can't talk too much about it, but I'll give a high level of thoughts. It's obviously a popular asset class that people are interested in. As an industry, I think we have the responsibility to create the right disclosures, the right safety standards, the right information, the right trading. Nothing's been approved yet on an ETF level. There's several companies that have filed for crypto ETFs. It's with the SEC now, and I don't, my guess is it's not going to get approved. In the next couple of weeks. It's going to be a little bit farther out, but it's an interesting space. And I think as an industry and as a regulator, they're going to take a close look at, how do we give clients what they need in terms of exposure to a crypto? It's too important of an asset class to just ignore anymore. But how to do that in a way that's safe for the masses, that gives the right information, the right safety, the right oversight, gives regulators the ability to look at the markets, to look at making sure there's no manipulation, to make sure that there's no mischievous activities by some that would affect the funds and retail clients. So, remember, when you put on an ETF, you can't just say it's for institutional or advisors or qualified investors. It's for the masses. So I think, the SEC is really responsible, has done a great job working with all its asset managers and exchanges of whatever we bring out, that it's at that point safe enough for the masses. So I think it's an interesting space. At Fidelity, we're highly engaged in all aspects of crypto, but we're also very committed, just as the regulators are, of producing products and offering our clients exposures that are safe, understandable, with training and education.
There's crypto exchange traded products in Europe. There's ETFs that have been launched in Canada. There's talk about Bitcoin ETFs listed in Dubai. So there, globally there is demand, and there are products that has launched. As Greg mentioned, in the US, there's a number of filings that are in place for Bitcoin or crypto or other digital asset ETFs, and we're working with the issuers to navigate the regulatory framework for it. The ETF offers an efficient way for investors to access the crypto market. In some cases more efficient than what's out there. So, my personal opinion is definitely something that we want to support as NASDAQ for the crypto ETFs. And it's not going to be something that's imminent, but we're going to be working closely with issuers and the regulators on how to navigate and address a lot of those concerns around investor protection.
Interesting. So we started, in the theme of the three webinars that we've done here with Saxo Bank have been the changing wealth industry, and the change from IFA, the way IFAs are paid, the way portfolios are now being created. As you mentioned, managed portfolios is becoming more available to a wider audience. The plethora of now very low cost funds and ETFs that you can build a portfolio with. Do you think that the wealth industry now continues to grow? What do you see as any new catalysts coming along? In our opinion at Saxo, we have witnessed, as everybody has witnessed, just a massive participation in capital markets through every form, whether it's through online platforms, through funds, through ETFs, direct. And do you see this continuing again, coming back to where we are in the cycle? Is it all guns blaring going into next year, or do we pull back? Is there anything to be concerned about? So I want kind of your final thoughts, guys, on where we are as an industry, and obviously, where you see it going in the next 2 years.
I'll jump in. I think we're in the United States, we're seeing the largest transfer of wealth ever. That's ongoing as we speak, as the generations move on. You combine that fact with the topic that we already talked about, the ease of use or the ease of investing, and you will see this transfer of wealth to continue to be invested. If I look at my own personal life, I didn't own a security in a savings account until I was in my 20s. My son, who's now 18, I bought him his first stock when he was 3, right? In a Schwab, account. So you combine those two things, and I definitely think, and he trades and he loves it. My daughter does as well, and they enjoy it. So I think that you will see that transfer of wealth to continue to be invested. Now, the other thing to keep in mind, and it's a much larger picture than what I can opine on, is just the macro events in the world. The central bank's decisions on what they're going to do with pumping money into the system or not. You start drawing out liquidity on it, and guess what? People are going to start selling things and not have the same type of investing mentality that we've had literally since 2008, globally. So I think that, 2009, so I think that you combine those three sort of factors. I do believe that you will see growth in the continued asset management business or asset management industry. But at the same time, you have to be definitely aware of where interest rates will move and the cost of capital. And I think that is going to change, maybe not in the next year, but I definitely think it'll change, drastically over the next decade.
The industry is still in shift. We saw a shift to fee-based advisors over the last 10 years. At Fidelity during the last year, we saw the largest amount of retail clients opened ever. I think that tells a statement of individuals are more concerned and involved with their investment. I think if you look 20 years ago, a lot of it was DC and DB plans, a lot of your savings, your retirement was taken care of by your company. Those days are no longer, there. So you've gone away from the institutional type of management for people where they don't have to worry about it, to advisors that are fee-based, as well as more individuals that are engaged. Once again, we talked about transparency, ease, education. So, between all the different factors of away from DB/DC to more individual, more information, more technology, younger investors, more in tune, hence the rise of ESG and people voting with their wallets, has changed that shift of how people think of investing. And I think we're going to see continuation over the next few months to years.
Zhang, from an exchange perspective?
Yeah, so I mean, as we talked a lot about just new investors and new participants entering the asset management space as investors or as issuers, it's ever the need for investor education is much greater. Financial literacy is very important and something that NASDAQ as well as Invesco and Fidelity is really focused on to make sure that people are making the right decisions and are has all the disclosure and information they need. And as investing will move towards more app-based and more social-based, that education is ever more important. And it's become very frictionless and cheap and easy to trade. So it's just something that we need to highlight and continue to do the best we can to make sure that the information is out there for people.
So certainly, from Saxo Bank's perspective, I would concur with everything you've said. We started out 28 years ago to democratize the trading and investing business. That was our goal, and that is what is happening right now. It's ability to access, in a cost-effective way. But I think you all have mentioned the key as well is with financial education. As long as that happens, and that's what I see across the industry now, literally retail / mass affluent are getting a service they've never been able to before, and they're now taking responsibility for their financial future, whether that's buying a car in the future or paying for kids' education. And they're doing that with, really risk weighted portfolios, which is a good thing. Obviously, we know markets don't always go up, and we know that we're possibly entering a period of volatility, which I think is why this debate is really interesting, because again, you can't just put money in an index and it goes up forever. And at some point you do need possibly to start being a bit more proactive and looking for value, which I think is possibly where we're arriving at today. But certainly there's never been more choice in terms of products available, with your great firms as well. So we're out of time. Any last final words? I really want to thank you guys. It was an excellent debate. A lot of wisdom and experience came into this. If you've got nothing more to say, I'll hand you back to Zach, but you may have any final words. Great, thank you so much.
Indeed, it has been a very interesting session, a great way to wrap up this three-part series with Saxo Bank. I cannot thank Saxo Bank enough, as well as all the speakers that joined today. Please save the date for the upcoming in-person AIM Summit Conference. We're going to be hosting that on the 11th and 12th of October in Dubai. Registration is going live next week. If you're joining us on YouTube for this session, please like this video, subscribe to our YouTube channel. Now go to aimsummit.com to register for our conferences, to attend our live sessions, be part of the Q&A. Thank you again to everyone. This has been a great session. Thank you to the audience for your great Q&A, and looking forward to having the next one.